The largest tech companies on Earth are currently locked in an artificial intelligence arms race, spending hundreds of billions of dollars to build massive models. But that spending has hit two hard physical limits that threaten to throttle the entire industry: securing enough electricity and finding enough raw computational power. That bottleneck is exactly where a company named CoreWeave stepped in. They started back in 2017 as a cryptocurrency mining operation in New Jersey. By March of 2025, they had pivoted their hardware entirely to AI, executing an initial public offering and becoming a darling of the public market. They achieved this by creating what they call the essential cloud for AI. Instead of building the models or manufacturing the silicon chips, CoreWeave operates strictly in the middle. They buy the world's most advanced graphics processing units, network them together inside massive data centers, and rent that raw computing capacity to anyone who needs it. By securing the hardware that everyone else is desperate to find, they have positioned themselves as a mandatory physical toll booth. If a tech company wants to train a leading AI model today, they almost certainly have to pay CoreWeave for the privilege. But renting hardware is a commodity. CoreWeave separates itself with proprietary orchestration software, its Kubernetes service. Think of it as a hyper-efficient traffic controller for data. It routes workloads fluidly between training and inference, so these expensive chips never sit idle. Their engineering is so precise that they have secured a deeply privileged relationship directly with NVIDIA. CoreWeave is consistently first in line to receive and deploy new hardware, like validating NVIDIA's highly anticipated Vera Rubin architecture at a rack scale. This access is invaluable. CoreWeave sits centrally, powering workloads for the world's leading AI labs: Microsoft, Meta, Anthropic, and OpenAI. This elite network drives triple-digit growth and a $99.4 billion contracted backlog, locking in years of guaranteed income. From a purely operational perspective, CoreWeave has secured the best hardware, built the most efficient software, and convinced the richest companies in the world to hand them nearly $100 billion. Which brings us to a massive contradiction. With a guaranteed $100 billion pipeline, why are the insiders suddenly abandoning their positions? Since the IPO, filings reveal a relentless wave of insider selling. The CEO and early backers have dumped more than $2.3 billion of stock. Meanwhile, public market tracking shows effectively zero open market purchases from company insiders. The people at the top are cashing out. This raises a central question. Why would a company with a $100 billion pipeline also carry the financial risk profile of a distressed borrower? Their business model has severe tension. Gross margin is a profitable 70%, but actual GAAP net income is a $1.2 billion loss for 2025. Because they must buy GPUs years before recognizing revenue, $30 billion in debt crushes their operating profit. CoreWeave functions as a highly levered financial engine, relying on constant debt refinancing to bridge the gap until those hardware contracts finally pay out. That leverage is compounded by a structural vulnerability. CoreWeave does not own most of the buildings or the power infrastructure where their servers live. They lease them. This leaves the company burdened with roughly $10 billion in long-term lease obligations and very little control over rising electricity costs. We can see how risky this is by looking at how their competitors are playing the exact same game. A competitor like Iron, a former Bitcoin miner transitioning to AI, physically owns its land and power facilities, entirely protecting it from third-party landlord risks. This matrix comparing CoreWeave directly against their closest rival, Nebius, is even more revealing. While Nebius has a much smaller operational scale, their balance sheet is drastically cleaner. They actually posted a profit in 2025 and operate with billions in cash and very little debt. And when CoreWeave bids for the largest global contracts, they have to compete against a legacy giant like Oracle. Oracle is spending aggressively on identical hardware, but they rely on a fortress-like global balance sheet to absorb the massive capital costs without risking the survival of the company. CoreWeave absolutely dominates its peers in pure revenue growth and scale, but its competitors' strategies expose the intense existential risk CoreWeave accepted when it decided to fund its massive expansion almost entirely through debt and leases. Because of that debt, CoreWeave is locked into a delicate balancing act. The company only survives if two external factors never change: Interest rates must remain low enough for them to refinance their loans, and the massive tech monopolies must continue their aggressive, relentless spending on AI compute. If those conditions hold, the bull case plays out. CoreWeave fulfills its $100 billion backlog, outgrows its debt burden through sheer scale, and cements itself permanently as the fourth major pillar of cloud computing. The base case is a rougher ride. They survive the expansion but remain a highly volatile, capital-hungry stock. Their valuation will swing violently up and down with every single headline about interest rates or shifts in hardware pricing. But if the AI bubble pops, or if credit markets tighten and those loans become too expensive to service, the bear case takes over. The demand dries up and the company is crushed under the weight of $30 billion in high-yield debt. CoreWeave serves as the primary high-beta proxy for the neocloud trade. It will either define the physical infrastructure of the next decade or prove that even record-breaking demand cannot save a company from its own balance sheet.